Chapter 4, Financial Accounting, Completing the Accounting Cycle, Part 1 of 3. Our first 3 chapters have been a comprehensive instruction on the accounting process. We learned about the accounting equation, and we've talked about how transactions fit into this accounting equation. We talked about the business and how businesses are set up and how their transactions fit into this accounting equation. Then we moved into these debit and credit rules and how they fit into getting our transactions recorded, our money that's exchanged hands, or the way that our accounting transactions affect the business and the business's financial position and their revenues and expenses. All of these things have been recorded in journals and ledgers and trial balances, and now it's time to complete the cycle. Always remember that this accounting process is pretty much automated. So if you go into a business, this is computerized. You're not going to do these things by hand. And fortunately, in an online class, you do all of this electronically. It's just a little bit more tedious because you're not just entering an account number whenever accounts pop up. You've got to have a little bit more knowledge. And as we've said before, the brains of the accounting cycle are understanding how to prepare adjusting entries, because these adjusting entries record the specifics of a transaction to make sure that the financial statements are ready and that they're accurate and that they are done by GAAP on an accrual basis of accounting, and they reflect the revenues, expenses, assets, and liabilities of a company. So let's see what we've got in Chapter 4 related to completing the accounting cycle. We're going to break this out first by talking about the unadjusted trial balance and how this can be used to prepare financial statements. And the financial statements we're going to be preparing are the same as Chapter 1, 2, and 3, but just a little bit more complicated, a little bit more complex, so that users have better information. Then we'll talk about closing the accounting records. You've probably heard of people say, we're closing this month, and so I've got some extra work to do. We're going to learn what the closing process is about, because it's meant to allow a company to start a new accounting period with new revenues and expenses. And then we'll go through a long illustration of the entire cycle. Okay, so this is what we did through Chapter 3. We learned how to get this adjusted trial balance together. Take a close look. You'll note that we've got all of the account titles here that this company uses. And let me give you a reminder that every company is going to choose accounts that fit into the accounting equation elements: assets, liabilities, revenues, expenses. Each company chooses their own account titles. No two companies will have the same account titles. These account numbers are used for referencing, but also in a computerized system. All you have to do is enter the number 42 and rent revenue pops up, and then you enter the dollar amount of the transaction. I got to throw this out as an auditor, and that's one of the courses I teach at the Citadel. Miscellaneous expense is something we frown on because it doesn't give you a lot of details about what's going on within that account. So we try to separate it in the real world, but for this textbook author, for these authors, they've chosen miscellaneous expense. Our debits and our credits are equal for this adjusted trial balance illustration, and we know that they've been adjusted, and we're sure that all the accounts. So look at this crazy looking thing. This is called a spreadsheet. Your book goes into a lot of details about a spreadsheet. We will not be going into a lot of details about these spreadsheets, not for this course. You won't see it on a final exam or on an exam. But this end of period spreadsheet just gives a lot of information that can be used to help the accounting individuals to kind of track what's going on. So let's look at the different columns. This is done, of course, on something like Excel, and that's really helpful. So here we have the unadjusted trial balance. If I can draw, there we go. And this is what happened after we had posted all of the transactions and the debits and credits. And then we show in this center set of columns the debits and credits related to our adjusting journal entries. Finally, here's our adjusted trial balance. And yes, this adjusted trial balance matches what we have with our adjusting entries. So unadjusted, adjustments, adjusted trial. Okay, so let's try this as a quiz just to make sure everybody understands. Which of these characteristics are true about a worksheet? Is it permanent accounting record? Is it an optional device, part of the general ledger, or part of the journal? And the answer is that it is optional, but we always want to say it's a very useful tool. And for individuals that will become accounting majors, they will find that Excel is used all the time. Okay, so here we go. It's time. It's time to prepare financial statements from the adjusted trial balance. So here's that adjusted trial balance again. Exact same numbers, whether we got it from the worksheet or whether it was pulled from our ledger. And I have to tell you, if you ever use this in an electronic format with a program, a general ledger program, you literally push a button and the adjusted trial balance prints out. And it balances, of course, and then you push another option and your 3 financial statements are prepared. So this is a review. Let's look at our financial statements. Here's the income statement, and as we can see, here's the revenues and the expenses, and these are the things that we've learned already. Now follow the red line and we will see that the net income from the income statement is used to prepare the second financial statement, which is the statement of retained earnings. I'm going to stop, give you a reminder to self-test as you go through this. And the questions I would ask are, do you know what the formula is for the income statement? And do you know what the formula is for the statement of retained earnings? And if you don't, look it up and see if you can find out. If you can't find that answer, shoot me an email and I'll be glad to help. Moving to our third financial statement that's prepared, the balance sheet. You can very easily see the balance sheet formula. It's also known as the accounting equation. This financial statement has assets, liabilities, and stockholders' equity. Here we see that the ending balance of retained earnings from down here is moved forward to this spot. Now, many times students think that they need to stick revenues, expenses, dividends on a balance sheet, and that is incorrect. Yes, it will make it balance, but it's much better to take this ending balance, which already includes revenues, expenses, and dividends, move it up, and make your balance sheet balance in proper format. All right, net solutions. Here's the final financial statements. Income statement, statement of retained earnings, balance sheet. I have to throw a couple of little side comments here. The income statement on some large corporations is called a statement of operations because it shows the operations of the company, their revenues and their expenses. The retained earnings statement, when we get a little bit more advanced, we're going to find that it is expanded into a statement of stockholders' equity. That's way down the road in this course. And finally, the balance sheet is occasionally listed as the statement of financial position. It shows the financial position of the company's assets, their liabilities, and their equity. One further comment for this slide that I think you should take note of. Look at the assets. There are subcategories here. And look at the liabilities. There aren't any subcategories on this one, but we will find on others that they are located. So just wanted to make a comment that we've got some new subcategories or subtopics for the balance sheet. The retained earnings statement generally has the beginning retained earnings. I want to make sure that we're familiar with the statement of retained earnings one more time. Beginning retained earnings plus dividends. Sorry, let me back up a minute. Beginning at retained earnings plus net income minus dividends equals ending retained earnings. So this is the pivotal financial statement of any company that helps to transition between revenues, expenses, assets, liabilities, and stockholders' equity. And if you can see the articulation, how each financial statement flows into the next, then you can see the algebra related to accounting, and you can see the double entry component. It's a big secret to success for those of you who are interested in accounting as a career. Let's talk about the classifications of the balance sheet. Generally, there are current assets, plant, property, and equipment, and other assets. And liabilities generally have two sections. There are current liabilities and there are long-term liabilities. So the current assets are those assets that we believe will be used in the company within a year or less. Plant, property, and equipment is going to be lasting a long time, and other assets are where we throw our other categories. Similarly, for liabilities, a current liability is one that we owe in the next year, and a long-term liability is a debt that we owe in longer than a year. Oops, sorry. And then when we come to the very end, we see that we have equity. And they have their common stock, and then they have their retained earnings and a few other accounts that are items that we have not discussed yet. I want you to take a look as well, and this is always a surprise to intro students. These amounts are in millions. So what this is telling us is that Walmart has $198 billion in assets, about $67 billion, that's with a B, $billion in current liabilities. Their total liabilities, you have to do a little math. I'm not real good at that. Let's see, that's another 15 and 40, 45. That's another, it's about about $118 billion worth of debt. Yes, that's correct. $118 billion worth of debt. And then here's their equity down here. And kind of interesting, look at the dates. Walmart's assets have gone down from 2016 to 2017, and their debt has gone up. Kind of shows what's going on with the economy with the brick and mortar stores. Okay, let's go a little bit more slowly with these current assets. Current assets are expected to be converted or sold or used up within a year. And here's a list of some examples. Cash, notes receivable, accounts receivable, supplies, prepaid expenses, that's like prepaid rent, prepaid insurance, and inventory. We haven't really talked about a store like Walmart yet, but inventory is a current asset. That's for a retailer. Make a note here, and if you're taking notes, this is a wise one to keep up with. Notes receivable are like accounts receivable, except generally they are more formal. They include interest. They have a payment plan. So if a business has a notes receivable from a customer, then they have interest coming to them and monthly payments. Let's take an example. A bank that loans money out to customers has lots and lots of notes receivable from the customers that have loans with them. That one usually takes students a minute or two to stop and think about, but a bank loans money to their customers, and those loans are notes receivable to the bank. So Wells Fargo has notes receivable from anybody that has a mortgage with Wells Fargo. PP&E, sometimes called plant assets, sometimes called fixed assets. An old term for manufacturing was the plant. Let's go to the plant. I can recall as my father is an engineer in the textile industry, he used to go to the plant every day. So that's, I think, the old school term for PP&E. And these are items that depreciate over time, which means that they decline in value, and we have to estimate or allocate their cost over the estimated useful life. Equipment, machinery, buildings, computers, trucks, and so forth. These are also called fixed assets. All of these terms are new to students. Again, I have to stop for a minute and give you a commercial. or a request or best practices. Please take notes. Don't rely on reading these PowerPoints. Research shows that by handwriting your notes, retention is increased. This research has been going on for years and it has still not changed, even with computers, laptops, and all the other electronics that we have. They find that somehow using a pencil and paper to write down notes enhances retention of that knowledge. So this is a new concept, fixed assets that depreciate over time. Current liabilities are generally businesses' money that they owe to creditors. They're sometimes called short-term liabilities, and here's a long list that you can read through. Notice just about all of them have one word in them: payables. Unearned fees or unearned revenue is also one of those quirky liabilities. There's another thing to add to your notes, and that is that unearned revenue is a liability because it's revenue that the company has received but that they have not yet earned, and as a result it's unearned, and the company has a debt to either repay that money to the customer, or they have to do the work or services or deliver the goods that they were purchasing. Long-term liabilities. Generally, this is debts of the business that aren't due for over 1 year. And these long-term liabilities generally are loans that maybe have a long payment period that they don't owe for a long period of time. Frequently, a company may borrow, let's say that a store buys a truck and has a payment plan. And let's say that this truck costs $50,000 and they're going to make payments every single month. Part of those payments will be a current liability, and the payments that are due in greater than 1 year will be considered a long-term liability. So take a minute. There's lots of new information, lots of new terms in part 1 of 3 in chapter 4. The worksheet is new, but these are called classifications on a balance sheet. They're subtopics or subcategories, and they help us to make decisions. We will find later that we will start calculating ratios, and we'll start talking about debt to equity and the current ratio, and get lots of different statistics from our business that we use and calculate because we have all of these categories. So what are we doing now? We've learned in chapter 1 how to prepare these financial statements. Here we are in chapter 4 looking at them again, but this time we're making them a little more complex so that they're much more usable and provide a lot more information to individuals that make decisions based on these financial statements. Part 2 of 3 for chapter 4, we'll be talking about closing entries. Make sure you understand this section because closing entries is going to be a new concept within the same chapter.